The capping of interest rates 2 weeks ago has been received with much enthusiasm from the public and businesses which for a long time had been squeezed by lending rates. Under the new Banking Act, banks are now not allowed to charge customers more than 4% of the central bank rate, currently at 10%. With the exit of the high interest regime, which ensured banks raked in billions of shillings, driven by interest income, strategy now is to tap other income streams.
The CBK governor has actually issued a warning to banks, cautioning them against issuing any new fees without its approval. So the CBK must be consulted by banks before they introduce any new charges.
This will require banks to be more innovative in order to increase non-funded income that makes up 30% of total income.
We believe that with increased focus on growing non-funded income, this segment should shift upwards, and so we'll see more income coming from the non-funded side, and so we expect the ratio to shift from 70-30 going forward to maybe 60-40, and even for the banks which are better able to leverage on their capabilities and to grow their funded income, we could see something like a 50-50 split between interest income and non-interest income.
As of 2015, 7 banks were controlling 67% of the loan portfolio, 59% of deposits, and enjoying 70% of profits.
So our sense going forward is that you may start to see some of the smaller banks begin to have discussions around consolidation. So mergers and acquisitions, M&A activity, larger banks buying smaller banks, or smaller banks merging with each other to become a large bank.
Kaniu says even though large banks are well positioned to contain the recent adjustments through reduction in operational cost, this may come at cost of some jobs. For potential homeowners, the cost of mortgages is expected to drastically reduce, hence drive uptake. Britam has further warned of uncontrolled inflation with borrowing that focuses on consumption due to affordable loans.